Good morning and welcome to the Killik & Co market update. There has been a lot of concern recently about the level of debt that the UK government is accumulating due to all the various support schemes that are in place to support us throughout the coronavirus, for example the furlough scheme. And it has been confirmed this morning that UK government debt has exceeded £2 trillion for the first time in history. So let's take a look back and see how our level of debt has changed over the last 15 years. As you can see from this chart here, the level of debt between the years 2007 and 2010 more than doubled as we dealt with the effects of the financial crisis. And since then, the level of debt has gradually crept upwards, but in the last year, the level of debt has spiked by more than £200 billion worth, the reason being the various government support measures for the coronavirus. So now we've got two issues: paying the interest on this high level of debt and also paying down the debt itself. And you could say that one possible saving grace at the moment is the fact that interest rates on government debt in the UK are relatively low, so we're not paying a huge amount of interest on the more recent debt that we've accumulated. When a government wants to borrow money, it generally issues government bonds. So let's have a look at the latest yields or interest rates on UK government bonds. And as you can see here, the interest rates on the 2-year bonds and the 5-year bonds are actually negative. So the government is actually being paid to borrow money. So why would anyone lend to the government and get a negative interest rate? Well, imagine that you're a pension fund or a big asset manager and you've got millions of pounds worth of cash. If you put that cash into a bank account, you're not going to be protected by the Financial Services Compensation Scheme. So if that bank goes bust, you could lose everything. On the other hand, if you put that money into UK government bonds, it's arguably seen as a safer choice, even though you might be paying interest rather than receiving it. So we've got negative rates at the moment on the 2 and the 5-year bonds. And then for the 10-year bonds, we've got a very low rate of 0.22%. So all UK government bonds have very low rates at the moment. Now, it's thought that government bond yields will remain at low levels for the foreseeable future, but no doubt the government is putting plans in place to try and bring down our level of debt before interest rates and bond yields start to rise. We've had two milestones this week for the S&P 500 index over in the US. One is that the index hit a new record high this week, and the other is that the big 5 tech companies, that's Apple, Amazon, Microsoft, Alphabet and Facebook, they have now become so large that they account for over 25% of the entire index. And if you bear in mind that the S&P 500 contains 500 different companies, it really is quite amazing that just 5 of these are now large enough to account for over a quarter of the whole index. And it really just showed just how well these tech companies have done in the last few months, with many of their share prices higher now than they were before the lockdown started. So the question now is whether or not some of these tech shares look incredibly expensive. Well, it depends how you measure them. Often when they're valuing shares, people use something called a price to earnings ratio. And this compares the current share price to the level of profits or earnings that that company is making. The lower the ratio, the more attractive that share is thought to be. And historically, a level of around about 14 to 16 has thought to have been quite reasonable. So let's have a look at a couple of examples. Microsoft and Facebook have price to earnings ratios of 32.6 and 28.7. So based on this ratio, some people might say these shares look expensive. GlaxoSmithKline and National Grid, on the other hand, have ratios of 12.9 and 15.8. So based on this particular measure, they look cheaper. However, if we look at something called a PEG ratio, which also accounts for annual growth in earnings or profits, the tech companies actually look cheaper. With a PEG ratio, again, the lower the number, the more attractive that share looks. And with a PEG ratio, a level of around about 2 is thought to be quite reasonable. So Microsoft and Facebook have PEG ratios of 2.1 and 1.8, whereas GlaxoSmithKline and National Grid have ratios of 3.9 and 5.7. So on this basis, the latter two actually look more expensive. The question now is, how sustainable do we think this annual growth in technology earnings is going to be? But at the moment, as we're moving into a time when people are really starting to use more technology, the opportunity for technology still looks very attractive. And finally, this week, the Dutch government is contemplating charging Unilever a departure tax of over 11 billion euros if the company decides to move its headquarters away from the Netherlands and into the UK. That's a huge amount of money, and to put it into context, it's about the value of the 3 smallest companies in the FTSE 100, so it really is quite a huge tax. And it perhaps is an example of the era of deglobalization that some people think we're moving into. Rather than focusing on the progress of the global economy as a whole, countries are now looking to focus on becoming more self-sufficient, and this is a theme that we could look out for over the next few months and years. Moving on to the week ahead, we're at the very end of earnings season now, so the diary is looking fairly quiet, but we have got results out from Salesforce and from Ping An Insurance. That's it from us. Have a great weekend, and we'll see you next Friday.